This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this second lecture on Chapter 9, we turn our attention now away from the exempt benefits where we left it, and now looking to probably the most examinable area of all, and that is the area of taxable benefits. As we said at the introduction to Chapter 9, that employment income doesn't just deal with salaries and wages. It deals with all emoluments derived from that employment. So there are many ways by which, if an employer is so minded, that they can provide benefits to an individual employee in a way other than simply in cash terms, the salary, a wage, a bonus or commission. And these areas are frequently tested within the examination, either as part of a Section C written response question or indeed individual points tested within individual objective testing questions, usually to be found in Section A. Now, this particular introduction to taxable benefits takes us through to, but does not include, probably the most tested area of all, which deals with the benefit of a provision by an employer of a, shall we call it in inverted commas, a company car, and usually what goes along with that car is the fuel paid for in part or in full by the employer as well. Now that will be a newly recorded lecture, Lecture 3 in this particular chapter, because there's been serious updates since the FA 2017 recorded lecture, and therefore we need a new one to deal with it. And that will follow on from this lecture. But this one gives us our introduction to taxable benefits. As you'll see here, probably the main area that we look at within this lecture is living accommodation. And living accommodation looks at the provision by the company, obviously, of the living accommodation, and may also include, of course, other expenses to do with that living accommodation. Now, for this and all the other parts of the content of this lecture on taxable benefits, we'll again be using FA 2017 lecture. All that will be different, as we'll point out in a moment, is that when we come to examples 2 and example 3, we're talking about different dates. Dates that in the lecture you'll see we're talking about the 1718 tax year, whereas now within these notes for Finance Act 2019, we're dealing with the 1920 tax year. But all calculations, all apportionments where necessary, all of the numbers are exactly the same. So, we deal with the main one, living accommodation. You'll be following it through on the FA17 lecture, which follows in just a few moments. In example 2, which tests out the issues on living accommodation, what we have got to do here in our version of the notes, the updated notes, is of course to deal with the 1920 tax year, assuming what you'll be explained about in a few moments' time, using an official rate of interest of 2.5%, a figure you may already be familiar with, and is on your rates and allowances tables. That hasn't changed since 2017-18, so it's exactly the same calculations. It's just that in the lecture you're about to see, we're dealing with the 17-18 tax year, rather than here in these notes and with the answer in the back, with the 2019-20 tax year. That then takes us through to, again, other expenses, as we mentioned a moment ago, connected with living accommodation. The use of then other assets. Now, the use of assets there, that is other than those that have a specific rule that deals with them. As you've just seen, and as you're about to see the detail of living accommodation, has its own specific rules. As I've mentioned in our next lecture, Lecture 3 in Chapter 9, you'll be dealing with probably the main area of testing, and that's cars and the benefit of fuel being provided by an employer. Those have got specific rules. Even vans and lorries indeed have their own specific rules, their commercial vehicles. But everything else, anything that isn't specifically dealt with, comes under this rule here, which again will be fully explained within the lecture, albeit the 1718 Finance Act 17 lecture. Now, again, when it comes to dealing with example 3, all you'll find is that the dates for the years has changed. Here we'll be talking about the 1st of June 18, and then from the 6th of April 19, i.e. the start of the 1920 tax year, whereas the dates in the example will be relevant for the 1718 tax year. But all the calculations, all of the apportionments done, albeit for different years, are exactly the same. There is no difference in terms of the principles there. Okay, so at this point, therefore, I commend you to the next part of the lecture, which again uses the FA17 material. That will go through on the FA17 examples, as we said, examples 2 and 3. But you use examples here from FA19 notes and go through the answers to them in the back of this particular text. We now turn our attention to the main issues likely to be tested in relation to employment income within any examination question. And that's dealing with the taxable benefits that may be provided by an employer to an employee. To begin with certain basic principles, that the amount assessed is generally what would be the cost of providing that benefit to the employee. So, for example, the employer pays for private health insurance for the employee and his or her family, and that is a cost of £2,000 a year, shall we say. Well, that cost to the employer of £2,000 will be an assessable benefit on the employee. A simple system. They've paid for something that the individual would otherwise have had to have paid for themselves. It's nothing to do with the business there. It's clearly a benefit. It is assessable. It is the cost of providing that by the employer. We might have some in-house benefits given the type of employer that they are. For example, individual works for an airline company and therefore gets free air travel. It could be that somebody works for a health club or gymnasium, call it as you will there, and of course they've got free access and use of the equipment within that health club, that gymnasium. Well, there it again will be based on a cost figure, but this time it is the marginal cost incurred by the employer. So although the health club membership might be £1,000 a year, the actual marginal cost attached to that particular employee now being a member may be £100. Now, how you get it is not an issue for you. You'd be told what that figure is, and it is purely the marginal cost, not what would be the normal price to be paid in relation to a membership of that gymnasium. Equally, as I said, with the airline there, what's the marginal cost of that individual going on that plane? It's not going to be huge, is it? That plane's going anyway. Again, if you're my weight anyway, it won't be much extra fuel to put you on there. And given the usual state of airline meals, it won't be much in the way of food cost either there. So it's not going to be huge. So it's marginal cost. What we're far more likely to see will be certain specific assets being provided to you. And the first of those, as we'll see in a moment's time, is living accommodation. Just one other to get out of the way before we get into the key areas. Vouchers that are exchangeable for goods or services there, unless specifically exempted, they again will be taxable, again on a basis of the cost to the employer. Living accommodation, right. This is one where, like with a car benefit or a fuel benefit, there's a calculation to be done. So we need to learn how to do that calculation. First of all, in terms of living accommodation, let's get this one out of the way before we go any further. There may be absolutely no taxable benefit that attaches to the provision by the employer to the employee of living accommodation, if the accommodation is said to be job-related. And as you might guess, job-related is specifically defined. The first of these, where it is necessary for the proper performance of the duties there of the employee to live there. For example, a caretaker lives on the site of which they are taking care. The school caretaker lives in living accommodation provided at that school. Or, if it's not necessary for the proper performance of the duties, it might be customary for the better performance of those duties there for the employee to be provided with living accommodation. And a typical example there might be hotel workers, or certainly a hotel worker like the general manager. And again, in a management position like that, they need to be available. They need to be on site 24/7 in case something goes wrong there. So they live, therefore, on site. That provision, again, is job related, and there'd be no assessable benefit. The third circumstance that will be determined on a case-by-case basis, where there is a threat to the employee's security, and therefore he or she resides in the accommodation as part of special security arrangements. They need to live there for purposes of security. Now, what we're likely to find is it's not job related, so there will be a benefit, and the benefit will be the hire of. It is probable that the property in your exam question is actually owned by the company. They bought it, they own it. And then you look at the accommodation's annual value. Now, you do not need to know how such a figure is determined. They tell you the annual value of the property is £5,000. There you go. That is the first figure that we would be looking to use. And that would be used there if that property is owned by the employer. But of course, the employer may be renting it and then providing it to the employee. So it is the hire of the accommodation's annual value, and if the property is rented by the employer, the rent that the employer actually pays for that. So if the rent, as it probably would be, is going to be higher, then that is the figure you'd be used. But the rent or rental value is irrelevant if it's owned by the employer, in which case it's that one, the annual value, that we pick up. If, of course, for the pleasure and privilege of living in that particular accommodation, the employee is required to pay some usually nominal amount of rent there to the employer, then the benefit will be reduced by any such rental contribution made by the employee to the employer. So that will come off at the end in determining the assessable benefit. Now, that's all it was. Again, it's a very simple rule there to pick up on. If it's owned by the employer, it's the annual value. Take away any rent actually paid by the employee to the employer for the benefit of living in that particular accommodation. If it's rented by the employer, then we take the hire of the accommodation's annual value, or whatever rent is being paid by the employer to the owner of that building. But if it is owned, and only if it is owned, then there will be an additional benefit. If it's rented by the company, the employer, then it's just the rental there, just the rental cost. But if it's owned, then where the cost of providing the accommodation is greater than £75,000, there is this additional, this expensive indeed, accommodation benefit. Now notice it is the cost. The cost of providing the accommodation is the purchase price, obviously, of the property. Probably any exam question is only that. But plus then any expenditure on improvements incurred before the start of the tax year. So they've added a conservatory, they've built a garage on the side there, put an extension on the property, whatever it might be. But if those improvements have occurred, I'll have to cross that out and rather more to underline it, the only improvement costs that we add in determining this expensive accommodation benefit is those incurred before the start of the year. If there was anything incurred during this tax year, a usual issue for an examination question there would be ignored. That will become a part of the calculation of the assessable benefit for next year, but not for this. Right, once we've got that cost figure, only if that is greater than 75,000 do we now determine this additional benefit. We take that cost figure minus 75,000. That's your cut-off limit. And it's been that for as long as I can remember. And I can remember a long, long time ago. So it's cost minus 75,000 times the official rate of interest, which for our tax year, again provided on your rates and allowances pages, will be 2.5%. If the employer bought the accommodation more than 6 years, before first providing it to this particular employee. Remember, the house in question, the living accommodation, I call it a house, flat, apartment there, whatever it might be, that might now be occupied by an employee who has more recently moved into it. But it had been bought by the employer many, many years ago, and previous to that it may have been occupied by other employees. But if the employer bought the accommodation more than 6 years before first providing it to this employee, then the property's market value when first occupied by this employee is used in the calculation instead of the purchase price. But again, note, if the cost is less than £75,000, there is no expensive accommodation, irrespective of the fact that the market value when the employee did indeed first occupy may be well in excess of £75,000. If the cost figures in relation to the property do not exceed £75,000 there, then there is no expensive accommodation benefit. And it doesn't matter whether this employee did occupy within 6 years of the company having bought the property or more than 6 years later. But we'll see that as an important issue as well. If the employer bought the accommodation more than 6 years before first providing it to the employee. Okay, let's have a look therefore at a little example here, example 2, to work out what we'll take as our assessable benefit in relation to living accommodation provided to this employee by the name of Jones. Occupies a flat owned by his employer. Right, as soon as we see it's owned, then the issue of rental being paid by the employer is irrelevant. They own it there. So we want to know the annual value. Well, we don't have to wait long. There is the annual value, £4,000. And Jones, this is the employee, pays his employer £500 per annum for the use of the flat. So not very much, but some rent is being paid by the employee to the employer. Now what that will be, that £500 there, watch how you read the question here. I've said per annum, PA there, per annum. I could have said per month, in which case it would be £6,000 for the tax year, not £500. So be careful when you read those questions, especially those objective testing questions. Read what is there, not what you think is there. Remember, there's no rewards for coming second in relation to an objective testing question. You make one mistake, you misinterpret one thing, and you get the wrong answer. You get nothing. So in which case, therefore, make sure you read it carefully. So here, annual value is going to be added in determining the employment income assessment, the assessable benefit. We'll be taking £500 out. Then, the flat was originally purchased in 2008 for £100,000. Now, two things of relevance here. The company actually bought it back in 2008, and they bought it for £100,000. Right, 100,000 exceeds 75,000. So there will be an expensive accommodation benefit. There'll be that extra to add in here. So we already know that we're going to have the annual value of 4,000. We now know that there will be an expensive accommodation benefit as well, and that will be something minus 75,000, the cut-off limit, times 2.5%, the official rate of interest here. The question is, what is that something going to be? Clearly, it cost there more than 75. Had it not cost more than 75, we wouldn't be doing this. There would be no expensive accommodation benefit. So 100,000 means it's expensive. But it was bought in 2008. Now that of itself is not necessarily an issue. What is an issue is when did this employee, Jones, first take up occupation of that property? Moved into the property in 2016, when then the property was worth £120,000. Right, go back and read this again. If the employer bought the accommodation more than 6 years before first providing it to the employee. Right, let's have a look at what we've got. They bought it in 2008, provided to the employee, this employee, in 2016. That, therefore, is more than 6 years ago. And on that basis, we will now apply this rule. This rule says that bought the accommodation more than 6 years before providing it to the employee, the property's market value when first occupied by this employee is used in the calculation instead of the purchase price. So what have we got? We now, instead of using the original cost of 100,000, will use the market value when this employee moved in. That is £120,000. That is the figure now to go into this calculation here. Now then, had you been told what the market value was now of this property, that is irrelevant. All you need is the market value when this employee moved into the property. And even then, it's only relevant if, when he did move into the property, the company had owned it for more than 6 years. So here, if, for example, he moved in 2016, fine. But there, 2008, if instead of the company having bought it in 2008, they bought it in 2012, well, 2012 to 2016 is only 4 years. So it wasn't, therefore, more than 6 years old when this employee moved in which case that figure going into the expensive accommodation benefit would not be what the then market value was. It would have been indeed the original cost figure of £100,000. So make sure you check that rule and you know what that is. Okay, so you then would put that through your calculator, get the expensive accommodation benefit, total it up. But of course that then is not the final assessable benefit, because that will be reduced by the rent paid or the contribution made by the employee to the employer. That would be, what was that? 500 there. £500, oops, 500, not 50. That is to be deducted, and then you would have your assessable, your taxable benefit, and that figure would be added into any salary and any other benefits there that were assessable in determining the employment income for the taxpayer for our 2017-18 tax year. Now again, you can work that calculation through, check that out please with the answer in the back, and make sure that you are happy with it. All right, we now move on to what is usually a part of the question that we've just seen. Because as well as providing the accommodation for the use of the employee, what the company might also be doing is to incur expenses connected with that living accommodation. So there are more costs being incurred by the employer on behalf of the employee. What do we do with those? Well, to begin with, a very obvious one. Expenses such as heating and lighting, your gas bills, your electricity bills there, are taxable on the employee if they are paid by the employer. Yeah, if the employer is paying for any of the running costs that attach to that particular property, then they are going to be assessable benefits on top of the annual value and the expensive accommodation benefit that we've already accounted for. Another typical and often significant cost that is incurred in relation to a property is a local government tax known as council tax. And if that is paid by the employer, it could run into several £1,000s potentially, so it's a big number. If that is paid for, again, by the employer, then that's going to be an assessable benefit on the employee, with one exception. When the accommodation is job-related. If it's job-related, then the payment of council tax by the employer is an exempt benefit, if again that accommodation is job-related. So that wouldn't go in. And in relation to the other benefits like the gas bills, the electricity bills there, any other expenses that may be incurred, water charges, for example, any such, then because you're required to live there, it's job related, they put a cap on what the maximum possible benefit from these other expenses might be. And that taxable limit is 10% of your other employment income, other than these particular amounts that we're dealing with now. Now that 10% figure there also puts a cap on not just those expenses, but also the use of assets. What may happen is that it's not just an empty property that is provided to the employee for then the employee to furnish the way that they will. What you might have is that it's furnished by the employer. So in relation to the use of such assets, the amount assessed is the higher of. Here's again a rule that needs to be learnt. 20% of the market value of the asset when first provided. Now that is when first provided to any employee, not necessarily just this employee. If this property has always been furnished and has been provided to another employee or employees before this employee moved in, it was the market value of the asset or assets when first provided, when first made available for private use that you use, not what happened to be probably the much lower market value when, of course, you moved in. So 20% of the market value of the asset when first provided, or now it's likely to be the first one, but you might be renting such particular assets. Rental paid by the employer if the asset is rented. Now that is a generic rule that exists for all other assets made available for the private use of an employee other than those where there is a specific rule, like the living accommodation seen so far, like cars, like fuel benefit, like, well, a fuel wouldn't be an asset, of course, but like a car, or even indeed like a van, not so luxurious as a car, but a van there, if provided. This is a generic rule by which we would normally compute an assessable benefit. But where we have certain other ones where there isn't a specific rule, like there is with cars, like there is with vans, there those rules apply. But anything else, for example, and where it's usually tested, the furniture and furnishings within your property, that's where you use this rule, 20% of the market value when first made available for private use. Okay, that one again typically used in dealing with your living accommodation. So up here, if we had been told that when our hero moved into the property in 2016, that it was refurnished at a cost of £15,000, then in working this assessable benefit here, you would be further adding in 15,000 times 20%, and that would be another £3,000 to go in there. So that, therefore, would be an extra benefit in relation to other assets made available for private use. So we will see this rule again in relation to other items, but again, it's usually applicable in terms of living accommodation. Now, what may happen in relation to such an asset, irrespective of whether the individual is provided with living accommodation, if you could, you'd have to do a good job here, but if you could convince your employer it was a really good idea for them to buy for you some expensive television, for example, and other audio-visual equipment, if the company bought that for you, for your usage, then you'd be using this 20% of the market value when first made available. And what that would equal would be an annual benefit. That would be the annual benefit that you would compute. So each year, 20% of the market value when first made available for private use, that would be an assessment on you. And that would go on and on for as long as you had the use of that company-owned asset. And that means that Yeah, 20% you're thinking, so 5 years at 20% would be 100%. It would keep on. If it was the 6th year, the 7th year, you would still be 20% of the market value when first provided. So what may happen if there is such an asset that has been made available for the private use of the employee? Well, probably the company doesn't want it back. So what may happen is that it may be transferred. It may be gifted or sold, probably at a distinct undervalue, by the employer to the employee. They don't want it on the company's books, they sell it off to the employee. So, situation. If an employee is gifted a new asset, so we haven't gone through this situation of company-owned asset being made available for private use, it is bought by the company and immediately gifted to the individual, then of course the individual will be taxed on the cost of the asset. The usual circumstance we get for exam is this one. The employee is indeed gifted an asset that has previously been used. Then he is taxed on the hire of. Obviously, one of the figures has to be, so what's it worth when they gift it to the individual? The market value of the asset at the date of the gift. Or, what is frequently the higher of these two figures, start off with the market value of the asset when first made available, so the original figure upon which the annual benefit has been computed. So that original market value made available to the employee, less any benefits assessed on the employee during the time he's had the use of it. So these annual benefits there. So we look at the original market value and take away any and all annual benefits. Ooh, where's that gone? The annual benefit there. Why do things disappear? There we go, the annual benefits. Take all those away, and that one minus the other would equal what we may call the tax written down value of the property. These rules do not apply to the gift of a car or a van, where the benefit is simply the market value of the asset when it is gifted. Okay, let's see if we can piece that together now in relation to example 3. Right, we've got to calculate the benefit assessable on Gerald in respect of the gift on the basis of if Gerald made no payment for the television, or if Gerald paid his employer £250 for the TV. Yeah, where of course it is gifted outright, then it is the benefit as we have computed here. But if we are talking about selling it off at maybe an undervalue or whatever, then of course anything paid by the employee will be an allowable deduction against that assessable benefit. So we've got to therefore look at two situations and deal with what we have here. These two calculations. What is the market value when it is gifted, and what then is its tax written down value? Right, Gerald. The employer purchased the TV 1st of June 16 for Gerald's use. It then cost £900. At the beginning of the 17-18 tax year, so on the 6th of April 17, Gerald was given the TV by his employer, its then market value being £250. So, how do we work out the assessable benefit? The assessable benefit is the higher of the market value. So in this first circumstance, what is the market value? Open market value is £250 there. And we're looking at it assuming firstly that there is no payment made for the TV. So there we go, that's the first of the two, the market value. Secondly, and the one that it's more complicated because you've got to do a working here, is its tax written down value. Now what would that be? That would be the original value when again supplied to the individual, which would almost inevitably be the cost. How much did they pay for it? And they immediately get it for the use of the individual. So that's £900, less any assessable benefits taken. So When was it first available? 1st of June 16. So the first tax year in which an assessable benefit would have arisen is 1670. We are seeing then, at the very beginning of the 1718 tax year, the asset is transferred to the ownership of the individual. So the only assessable benefit that will have arisen is the assessable benefit in 1617. But look, it's only the 1st of June 16, so it's not even a full year's worth of assessable benefit that has been charged for the 1617 year. So what would a full year's benefit be? Let's just do a little working of that. A full year's benefit would be 900 times 20% would, I think, be £180. But we only get assessed from the 1st of June 16. So how many months is that? Work it through. So that would be 10 months, methinks. 180 times 10 twelfths, 5/6 of that, well, that'll be a nice round number, £150. So what is the tax written down value at the date of the transfer that is the start of the 1718 tax year? Answer, what was the original market value? So look back to this information here. What was the original market value of the asset? That was £900 there, when first available, less the benefit assessed on the employee during the time he's had the use of it. It's only that 10 months of the 1617 year. That is 150, so 900 minus 150 is £750. So, which is greater, the open market value of 250 or the tax written down value of 750? Clearly, it is the 750. So in the 1718 tax year, there's an assessable benefit, the gift, the transfer of that to the individual employee, to Gerald, of £750. That's the assessable benefit. What happens if Gerald paid his employer £250 for the TV? Well, the two calculations to begin with don't change. It is the higher of the market value at the time of the transfer, 250, or its tax written down value. So here in this second part, that is 750. But now, of course, we will deduct any price paid. How much does he pay? Just see it in there, £250. Minus 250 equals £500 there, 500. So now the assessable benefit would be brought down to £500. Okay, if therefore you could check that one out in the answer in the back, please. And then next time we'll get into, well, probably the most examinable area of any or all of the benefits that we see, motor cars. So we won't make a start on that now. We'll deal with that when, again, you come back in our next session together.